Today, I have a challenge to help you become great. If that sounds like something you want, then keep watching. Plus, I've got all the great trading nuggets and trades as usual. Hi, this is Tim from TradingStrategyGuides.com. Today I'm going to show you a simple candlestick pattern that can be pretty powerful when you see it, and you don't necessarily have to use it when it happens to be able to reap its benefits. And you know, it looks like I'm going overboard on the Forex setups. I can't help myself. They're just really looking good. Today's setup is a range on the New Zealand dollar US dollar pair, and I'll get to all that shortly, but first, updates on the open trades, and then later the trading maximum for the day. Hang with me for a few minutes. Remember to click the subscribe button and hit the bell so you don't miss any of these great trade setups. Alright, time to look at the charts. I do hope you were paying attention in Friday's video and watched Ethereum at the close, because it closed below the descending triangle. I got short right there. Target was down here at 140.22. Hit the target on Sunday, took half off as usual, set the stop to break even on the remainder, and then today stopped out break even. I would have loved more of a move down, but a winner's a winner and I'll take it. This EURUSD setup is one from my new strategy video last Monday. It closed right here below the 20 EMA on Thursday and hit the target on Friday, just barely. So I got short at 110.58, 10.59-ish. Target was 110.16, and it's pushing down now. Took half off, set the stop for break even, and that's where my stop is right now. It's currently near a strongish level. You see these wicks right here. So hopefully it'll break through this level and drop from here. In any case, we've got a winning trade. The Aussie Swiss hit the stop today. So I'm done with this trade for right now, but it is still making this bear flag right here. So I'm going to continue to watch this one. The US dollar Japanese yen broke from this little bitty triangle that it was making here. I think I may have showed you that last video, and it broke to the upside. So in keeping with my belief in these patterns, I'm closing this one for a small loss right here, and I'm done with the dollar yen for now. Okay, let's take a look at the New Zealand US dollar setup and the candlestick pattern that I was telling you about. We've got a really good trading range on the Kiwi US dollar right here, and the candlestick pattern I want to show you is what I've always called a tweezer pattern. We've got several nice tweezers here, here, and here, and a multi-tweezer over here. To understand what happened here, imagine what this pattern looked like as it was forming. The first candle pushed all the way up here and was rejected and closed way down here, making a pin bar. You know that wicks represent price rejection, right? The buyers tried to push the price up here, but there were so many sellers that the price was rejected and pushed back down here where it closed for the day. Then the next day, the buyers tried once again to push the price up here, and the sellers rejected it and pushed the price way down here this time. And you can see that's exactly the opposite of what happened down here. Not enough sellers and too many buyers, and price was rejected down here as well. And back here it happened more times. The wicks are smaller and there are more of them, so the balance of buyers and sellers was more even. But eventually the sellers won out and price went down here. Why is this important? Because this much rejection at a certain price level, notice I said level, not at a certain price. If you've been around here a bit, you've heard me say that a line is never just a line, it's always a zone. The resistance level can be many pips above or below this line, so when you're setting up a trade, give it some space to push through the level. In any case, the more wicks, the more tweezers, the stronger the support or resistance level. And you can take advantage of that knowledge into the future like we're doing with this setup right here. I've identified these range levels based on these candlestick patterns. So here's the trade plan. We'll buy a daily close above the range or above 64.40, or we'll sell a daily close below the range or below 62.40. On the breaking candle, you want to see the volume reach up to the volume average right here to take a full-size position. If it doesn't reach the average but does reach at least 75% of the average volume, I'll open a half-size position to reduce risk. You can calculate the percentage by dividing the volume by the volume average, and you should get 0.75. If you don't get at least 0.75, stand aside on the trade and wait for the next opportunity. Your stop loss will be 1.5 times the ATR, and your first target will be 1 times the ATR. What that means is on the breaking candle, you'll look over here to get the ATR, and let's say this candle breaks up here, and that's your entry. You will measure 1.5 times the ATR down here, and that'll be your stop loss. You'll measure 1 times the ATR up here, and that will be your first target. Of course, it'll be the opposite if you get a close down here. Now, if after you enter this trade you get a close back inside the range, take your stop right then and don't wait for it to hit the stop loss. Our intention is that a breakout outside of these patterns should be explosive and hit our target fairly quickly. If the momentum goes away, we want to shut the trade down without taking a full stop if possible. When the price hits our first target, we will close half the position for profit and set the stop loss to break even on the remainder. We will then follow stops as price moves in our direction until the market takes us out. These two rules are the very definition of cutting your losses and letting your winners run. Typically, I do this with 2 positions. The first position has a hard stop loss and a hard take profit at the appropriate prices. That position will close automatically when the first target is hit. The second position will have a hard stop loss and no take profit directly associated with it, and that's the position that we'll allow to run. When the first target is hit, we will have to manually move our stop loss to break even on the second position. I will risk about 2% of my account on this trade. And that's today's setup on the Kiwi US dollar. Now, I want to challenge you to be great, and to be great, you must step up and speak up. My question for you today is, are you going to take the trade I outlined today, yes or no? And why or why not? I always tell you this, but I want to make sure that you remember that I'm not telling you what to do here. I ain't your mama, right? I'm just telling you how I handle these trades. If you want more details about what I do, look below this video for a link to my trade management video. And if you've got your own trade management plan that works better for you, by all means use it. Trading is a very personal thing, and things that work for me may not work for you. You have to understand your own mind to find the best strategies for your own trading. And psychology, of course, in my opinion, is the most important part of trading. And the trading maxims are my way of helping to handle my personal psychology. A maxim is a general truth, fundamental principle, rule of conduct, or proverbial saying. The purpose of my maxims is to motivate me to discipline in trading as well as other areas of my life. I suggest you start your own list of maxims, things that you can say to yourself while you're trading or doing life to make sure you always do the right thing. Feel free to borrow from my list. And today we're going to go back near the beginning. Tim's trading maxim number 2. There will always be another trade. Did you miss a trade setup? Don't chase it. If you didn't get it, just forget it and move on. I know I hate missing something I've identified as a high probability trade setup, but once it's missed, then it's no longer high probability, and it's stupid to enter it then. Yes, I understand FOMO, the fear of missing out. But you need to know that there will always be another trade. You missed this one, but 10 more will be along in due time. Be patient. Don't be stupid. Don't deviate from the plan. And speaking of the plan, remember our New Zealand dollar US dollar trade plan. We're going to buy a daily candle close above the range or above 64.40, or sell a daily candle close below the range or below 62.40. If the volume is not quite average, go half size as long as it's at least 75% of the average. Your stop loss is 1.5 times the ATR, and your first target is 1 times the ATR. And remember to click the link below to the trade management video for more details. And speaking of missing trades, sign up for my free Trading Picks email list so you don't miss them. I'll be sending out 3 or 4 trading picks a week, from stocks to futures to cryptos to Forex, and you'll be the first to see them. And the best thing is, it's free. I'll put the link below this video. Be sure to come back to Trading Strategy Guide's YouTube channel every week on Monday, Wednesday, and Friday at 3 p.m. U.S. Eastern Time. We'll have a nice trade set up or 2 on each one, and maybe some extra Q&A or training. Don't hesitate to ask any questions you may have. I'll either answer your question right in the comments or in a training video, or both. And remember, the only stupid question is the unasked one. And please don't forget to tell me in the comments whether you're going to take today's trade setup. Tell your friends about us and help us make this the best trading channel on the internet. As always, thanks for watching, thanks for subscribing, and don't forget to hit the thumbs up below. Have a great week, and I'll see you next time.